The first trading day of 2026 revealed something fascinating. Markets opened strong, semiconductors surging, indices climbing as much as 1.5%. Then the fade began. By close, the Nasdaq surrendered all gains, the S&P barely held green, and the Magnificent Seven shed a full percentage point. This wasn't panic. This was exhaustion masquerading as caution. I've been tracking market psychology for over 2 decades, and what I witnessed yesterday was a behavioral signature I haven't seen since the dot-com peak. The crowd still wants to believe, evidenced by Wall Street's unanimous bullish forecasts for 2026, but their actions tell a different story entirely. Today I'm going to show you why this market behavior is not just predictable, but exploitable. We'll examine the psychological fractures beneath 3 years of relentless gains, decode what the system is actually telling us, and reveal the Stoic approach that positions you ahead of the emotional crowd. Let's get into it. The human layer here is textbook behavioral finance. Recency bias is colliding head-on with valuation anxiety. For 36 months straight, investors have been conditioned to buy every dip, rewarded by AI narratives and Fed liquidity. But something shifted. The Santa Claus rally failed for the 3rd consecutive year, a statistical anomaly that signals changing sentiment beneath the surface. Watch the psychology unfold. Tariff relief on furniture sparked brief euphoria in home goods retailers. An 8% pop in RH demonstrating how starved the market is for positive catalysts outside the AI complex. Tesla's delivery miss barely dented the stock, a sign that bad news is being tolerated rather than punished. This tolerance isn't strength, it's the market pricing in mediocrity while hoping for miracles. The fear-greed index sits at 34, improved from extreme fear but still firmly in cautious territory. Crypto mirrors this ambivalence. Bitcoin hovering near 88,000 with outflows continuing and sentiment refusing to ignite. The psychological game theory at play is simple. Everyone knows valuations are stretched, everyone knows earnings must justify prices, and everyone knows the next shoe could drop from Fed policy, tariffs, or AI spending fatigue, but no one wants to be the first to exit. Predictable. Almost sad, really. Now let's examine what the system revealed yesterday. Semiconductors rallied hard. Micron and ASML posting 7 to 8% gains on analyst upgrades tied to AI memory demand and TSMC capacity expansion. This is the AI thesis in its purest form. Infrastructure spending driving chip demand, driving valuations, driving index performance. Yet the Nasdaq closed flat and the Magnificent Seven fell. The divergence signals that the market is no longer willing to lift all boats. Selectivity has replaced momentum. Look at the index behavior. The Dow outperformed, up 66 basis points, driven by industrials and cyclicals. The Russell 2000 gained over 1%, small caps attempting to reclaim relevance. The S&P 500 barely held gains, propped up by semiconductor strength but dragged by consumer discretionary and mega-cap tech weakness. This is not a healthy bull market. This is a market rotating defensively while clinging to the only narrative that has worked. Sector dispersion widened. 5 sectors rose, 6 fell, with industrials leading and consumer discretionary lagging. The mega-cap trade is losing its gravitational pull. The market is no longer willing to pay any price for growth. It is demanding proof. Bond markets are sending a different signal entirely. The 30-year yield hit its highest level since September, rising despite expectations for Fed cuts. This is the market pricing in either persistent inflation, fiscal concerns, or both. Long-duration assets are being sold, a sign that investors are not convinced the Fed can cut rates without reigniting price pressures. Volume was anemic, typical for a holiday-shortened week. But the intraday reversals occurred on rising volume. This is distribution, not consolidation. The technical picture is deteriorating beneath the surface, and the VIX remains subdued at 14.51. This is complacency, not confidence. When volatility is this low and valuations this high, the system is primed for mean reversion. The macro forces are converging. The Fed is divided, Trump is threatening to replace Powell, and rate cut expectations are being pushed further into the year. The labor market is softening. December payrolls expected to show only 55,000 jobs added. This isn't strength. This is a labor market losing momentum while wage growth remains elevated at 3.6% year over year. The Fed is trapped between slowing growth and sticky inflation, and the market is beginning to price in the possibility that neither outcome is favorable. Here's where Stoic discipline separates the exploiter from the exploited. The market is not lying, it is simply revealing what it always reveals. The collective uncertainty of participants who do not know what comes next, but must act as if they do. Yesterday was not a bullish or bearish signal, it was a signal of indecision. And indecision at all-time highs is a condition to be respected, not dismissed. The market has entered a phase where narratives no longer override fundamentals. For 3 years, the AI story justified any valuation, any multiple, any price. That era isn't over, but it is maturing. The market is now asking which companies will actually generate returns on the hundreds of billions being spent on infrastructure. Micron and ASML rallied because analysts provided specific answers tied to DRAM pricing and TSMC capacity. Tesla fell because deliveries declined for the second consecutive year. The market is differentiating, and differentiation is the precursor to dispersion. The failed Santa Claus rally isn't superstition. It's a pattern that reflects year-end positioning and early-year reassessment. 3 consecutive failures suggest that institutional capital is no longer willing to chase into year-end. This is a behavioral shift, not a technical anomaly. The implications are straightforward. The market is no longer on autopilot. It requires catalysts to move higher, and catalysts are becoming scarce. The tariff delay reminds us that policy remains the dominant variable. Markets rallied on the news, but the rally was narrow and faded quickly. This is a market that has learned to distrust policy announcements, having been whipsawed by tariff threats and reversals throughout 2025. The real risk isn't what is announced, but what is enacted. The bond market is signaling that the Fed's path isn't as clear as consensus believes. The 30-year yield rising indicates that long-duration investors are not convinced the Fed can cut rates without consequences. This is the market pricing in either a policy error or a structural shift in inflation expectations. Either outcome is unfavorable for equities at current valuations. The Stoic exploiter doesn't predict which scenario will unfold. The Stoic exploiter prepares for both. The upcoming data will determine whether the market can sustain its current valuation. ISM. Manufacturing PMI expected to remain in contraction territory. Jobs report expected to show slowing payroll growth. CPI expected to remain sticky. If the data confirms this narrative, the market will face a choice: price in slower growth or price in persistent inflation. Neither outcome supports current multiples. The anti-fragile approach is clear. The market is not in a regime where buying every dip is rewarded. It is in a regime where selectivity, discipline, and risk management determine outcomes. The AI trade isn't dead, but it's no longer indiscriminate. The mega-cap trade isn't dead, but it's no longer dominant. The bull market isn't dead, but it's no longer effortless. The Stoic exploiter doesn't fight this transition. The Stoic exploiter adapts to it, knowing that the greatest opportunities emerge when the crowd is uncertain and the system is fragile. This is exploitable because human behavior remains predictably irrational, even as market conditions evolve. The crowd will continue to chase narratives while ignoring fundamentals. They will continue to hope for easy gains while avoiding difficult decisions. They will continue to react emotionally to data while missing the deeper structural shifts. We remain disciplined. We focus on what we can control: position sizing, risk management, and systematic analysis. We accept what we cannot control: Fed policy, geopolitical events, and market timing. We prepare for multiple scenarios rather than betting on single outcomes. The system rewards patience over urgency, discipline over emotion, and preparation over prediction. History shows humans consistently make the same mistakes during periods of uncertainty. They either panic and sell everything or become complacent and ignore mounting risks. Second-level thinking means recognizing that this market transition creates opportunities for those willing to think differently than the crowd. While others debate whether we're in a bull or bear market, we focus on identifying which companies and sectors will thrive regardless of the macro environment. The crowd reacts emotionally to daily market movements. We remain disciplined, knowing that the greatest wealth is built by those who can maintain clarity when others cannot. If you value systematic thinking over emotional noise, and you're ready to approach markets with the discipline that separates exploiters from the exploited, then subscribe to this channel. In the description below, you'll find the link to download the complete Stoic Exploiter Framework, the full methodology for turning human irrationality into consistent advantage. The market will continue to provide opportunities. The question is whether you'll have the discipline to recognize them.